Federal Reserve yesterday voted to leave interest rates unchanged for the first time since July. The two Fed governors appointed by President Trump disagreed with the move, mirroring Trump's call to lower rates in their dissent. Let's bring in former Treasury official and Morning Joe economic analyst Steve Rattner, who has charts on yesterday's Fed decision. First up, explain the pause, Steve.
Yeah, as you said, Mika, the Fed has been reducing rates pretty steadily since July, when they peaked at about almost 5.5%, and they've gone down, 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 down to here, and the Fed has decided to take a pause. And also, a couple things about this. First, the Fed's outlook is that while it will resume cutting rates, only probably one more cut, 1/4 percentage point this year, another 1/4 percentage point next year. And then mortgage rates, which is very much the focus of the president and everybody else because they've been so high, do come down a bit with the Fed, but the Fed doesn't directly control them. They're a little over 6% at the moment, and so you shouldn't expect a major decline. This is not obviously going to make it easier for would-be home buyers, but this is what it is. Why did the Fed do that? In part because inflation has not yet quite come down to the Fed's target of 2%. You can see it has drifted down, down, down to here, but it's sitting at about 2.5% now, and both the Fed and Goldman Sachs don't expect it to get to 2% until after 2027. And so that is kept the Fed from being more aggressive, one of the reasons anyway, from being more aggressive in cutting rates.
So despite threats of investigation and everything else, Jerome Powell leaving rates where they are, disappointing the president for sure. In your second chart, Steve, GDP growth is solid. That's good news, and that's a number that may factor into your first chart as well.
Exactly. So that's another reason why the Fed is not cutting rates more aggressively. The economy has been surprisingly strong, at least in terms of overall economic growth. You can see here in the second and third quarters, it grew at over 4%. That's a pretty extraordinary rate. It is expected to come down a bit to 2.5%, still a good number in the fourth quarter of last year. And then 3% this year, also a good number. Part of it has been AI. We don't have that for these projected numbers, but AI has been a significant portion of the growth to date. Another significant portion of the growth to date has been productivity. Productivity means how much an individual worker produces. The more he produces, the more efficient he is, the better it is for the economy and ultimately for wages. Productivity bounces around. Economists are not great at forecasting it. But you can see here that for the last 2 quarters, it has been exceptionally strong, well above its average rates. People are not sure exactly why, but I think AI is certainly playing a role in this. And also business tightening its belts in the wake of Trump's tariffs and the general unpredictability of his economic policies has led business to be more cautious, restrain hiring, which is good for productivity. So that's another positive tailwind for the economy.
So, Steve, as we go to your third chart, let's talk about employment. Amazon making big news yesterday with layoff of 16,000 corporate employees. What do the numbers look like across the country?
Yeah, so the flip side of strong productivity growth is companies need fewer workers, and that's what's been happening. You've had quite slow employment growth. This goes back to Liberation Day, which was in April, so starting with the May numbers, you can see that employment growth, which is these blue bars, has been well below the historic average since COVID, all the way up here at almost 200,000 jobs. It's been only about 48,000 jobs. About 12,000 jobs over this period on average. But also, Powell has said that the statistical collection methods have been a little bit squirrely, and he thinks job creation has actually been negative over this period, negative by 48,000 jobs. So either way, it's not great news for Americans on the job front, in large part because of these productivity improvements that I talked about. Now, this is translated through, and I know you're going to talk a little bit more later about the economy, this is translated through into consumer confidence. We just got a consumer confidence number the other day from the Conference Board, and can see that it is the lowest reading we've had, including COVID, all the way back to 2014. So consumers are still very unhappy. They're unhappy about inflation, which still remains well above 2%. They're unhappy about the job market. They're unhappy about mortgage rates and the whole affordability question. And so even though overall top-line economic growth has been pretty good, it has not translated into much benefit for the average worker.
All right, Morning Joe economic analyst Steve Rattner, thank you very much for coming on the show this morning. We appreciate it.